What I'm going to do today is really two things. Firstly, I'm going to talk a little bit about definition, what Tim's just talked about. In our view, if you get definition right, you can't help but achieve a reasonable outcome here. Definition is the key here, because if you define infrastructure tightly and rigorously, then you'll end up with very predictable, reliable earnings. And I'm going to talk a little bit about that. This is a common theme whenever we talk about infrastructure. And reliable, predictable earnings ultimately mean reliable, predictable investment returns. So that's going to be the starting point. The second point we're going to talk about is really the sizzle, where there's growth. And one of the things that we've found increasingly with infrastructure, that there's a number of different sectors who are exposed to long-term, very long-term structural growth in underlying earnings. And it's that long-term growth and structural growth in earnings that gives us a high degree of confidence that we can achieve not just reliable, predictable returns, but hopefully something a little bit better. And I'm going to go through the different some of the different sectors and where we see those opportunities. 4 parts to this discussion. Definition first, why definition leads to predictable earnings. Secondly, utilities and why we see or where we see long-term growth. Most people, when they think of utilities, would not necessarily perceive there to be long-term structural growth, but I want to take you through some particular opportunities that we see there. Infrastructure, where we've talked historically a little bit more about growth, and we'll touch on that again today. And then finally, we'll talk about the fund, our current positioning and the outlook. All right, so why does it lead to predictable earnings? So we start philosophically with the view that infrastructure, when investors allocate to infrastructure, if they're doing it to a separate asset class, and they should, then it's about what they're looking to get is different risk-return characteristics, and infrastructure is different on the risk-return metrics in that it delivers you very reliable returns. So how does the industry typically define infrastructure? It's done it by virtue of the term essential assets. That is, assets that provide services that are essential for the efficient functioning of a community. Communities rely upon electricity, they rely upon water, they rely upon transport, and the demand for those assets is very reliable over time. And that's ultimately what essential assets delivers you from an investment perspective. That is reliable demand. But if I go back to philosophically where I started, and that is that infrastructure in our view is about reliable investment returns, then we don't, reliable demand, predictable demand is kind of interesting, but we want reliable, predictable earnings. So we have a second test. We start with the group of assets that meet the first test. There's about 350 of them with a market cap of about $3 trillion US. And we then segregate to the things that we're particularly interested in. They are those things where earnings are not sensitive to external variables. And the particular variables we're focused on are sovereign risk, competition, and commodity price. So sovereign risk for us, that means no China. Now, China has incredibly attractive themes as it comes to infrastructure. Car ownership in China has grown at 17% compound over the last decade. So you build a toll road in China and they will come, you will get traffic, almost as night follows day. However, it doesn't necessarily mean you'll get cash flow. And why? Because the Chinese government has on occasion interfered with the underlying concession rights. They've mandated that trucks carrying food are toll-free. They've mandated that on the 8 national public holidays that everything is toll-free. And that works so well for them, they then went, actually, we're going to do that for 20 days a year. Now, they've done all of these things for very good public policy reasons. So we support them in that, but we, as the owner of those assets, would want compensation for that. Now, good luck with that in China. And for that reason, China is out. Russia is out. Other little hotspots are out for us as well. So we're particularly focused on that. And then that removes around about 40 to 50 companies from our potential universe. So we've started with 350 companies or so. That brings us back to about 300. Commodity price. In the US, there's a lot of energy infrastructure assets, and the way that the energy infrastructure industry has grown up in the US is it essentially tolls the value of the product that goes through the system. These energy pipelines is what they are. They typically look and feel a lot like infrastructure. That is, there's a lot of capital expenditure to build these things with a long series of cash flows into the future. But they're tolling the value of the product that comes through the pipeline system, and therefore as the oil price rises and falls, so do your revenues and so do your earnings. And one thing we are not at Magellan is the forecaster of commodity prices. That's not our core competence. Indeed, it's not clear to me whose core competence that is, but it's certainly not ours. So we exclude that. And that excludes about 80 stocks from our universe. We started at 350, minus 50 for sovereign, minus 80 for energy risk, if you like, energy or commodity price risk. We're now down at about 220. We then strip out anything with competition risk, and the key thing we're looking out for there is power generation. Most power utilities around the world are integrated vertically across the industry. That is, they're in power generation, they're in transmission, they're in distribution, the poles and wires into your home, and then someone sells you their power. Now that first bit, power generation, in Australia last year, calendar 2018, the average price of power was roughly $90 a megawatt hour. It differs from state to state, but was approximately $90 a megawatt hour. So that's the average price. The maximum price was about $14,000 a megawatt hour. So $90 to $14,000. Now, particularly dangerously, the minimum price was negative $550 an hour. So this is a price that's definitely not reliable and predictable, and therefore nor are revenues and nor are earnings. And the bulk of these integrated utilities with exposure to that sort of competition risk are all part of different indices that are out there. And there are 9 or 10 different indices that we could be potentially benchmarked against. So those companies, for us, are a concern. And indeed, we'll kick out anything where more than 25% of earnings are exposed to that merchant power risk. Competition as a general rule is something we don't like. We think it's great for consumers. We just think it's a terrible thing for infrastructure investors. And as I say, that kicks out about another 80 companies. So we go from 350, 300, 220, now down to 140. 130 to 140 is roughly the size of our universe. It's a universe that's highly reliable, highly predictable, very resilient in terms of the underlying earnings. There's really not too much that can throw these companies off in a portfolio sense. You'll get the odd PG&E happening, but in a well-structured portfolio, you should be very, very confident about the nature of returns over a 3 to 5 year time frame. These earnings are highly reliable, highly predictable, and ultimately that means highly reliable, predictable returns. These should be no excuses. So commodity prices are not an excuse for this. Economic growth is not an excuse because these are essential services. You need these things. Competition is never going to be an excuse. And provided we get that definition piece right, we should not be able to do anything other than deliver you CPR plus 5, and that's certainly what we work towards. So definition critical here. This is what our universe looks like. We talk about 130. It's somewhere between 130 and 140 stocks in our universe. 3 major components. Regulated utilities represent roughly 60% of our universe across the water, gas and electricity spaces. These are all utilities where a minimum of 75% of earnings are regulated. Transport infrastructure, so toll roads, airports, communications and so on. Transport infrastructure tends to be regulated at the point of price rather than earnings, and therefore we can identify assets where volumes are growing for structural reasons over long periods of time. Then these are potentially highly attractive assets. So that's roughly 40%, and then social infrastructure, which is essentially government leases of schools, hospitals and the like, that's roughly 1%. It's a very small slither, but it's certainly out there. It's a much bigger part of the unlisted infrastructure environment, but in the listed world, it's only 2 or 3 companies. So that's the universe that we invest in. It's roughly $1.5 trillion US, so it's sort of the same size as the Australian Stock Exchange across around 130 to 140 companies. The things below the dotted line are things we exclude from our definition. So you'll see power generation, MLPs, which is energy infrastructure and the like. All right, so let's talk a little bit about utilities. Now, utilities are regulated, and regulation essentially around the world works the same way, and that is it allows utilities to earn a fair return, and a fair return is set at around about 10% return on equity around the world. Slightly different ways and different metrics, but essentially 10% return on equity. The way that works is that utilities are allowed to charge for their price to earn that 10% return, and it shouldn't really matter what gets thrown at them. There should be very little potential for loss. In other words, they get to adjust their prices to make sure they keep that 10% return. So it's certainly not get rich quick, but you should be growing your wealth with a high degree of confidence here, and that's certainly what we believe infrastructure is about. So that earnings regulation leads to very stable financial results and therefore very stable, predictable investment returns. And this is looking at what we would see as a sort of US regulated utility index. This is the return on equity achieved by these utilities sort of over the decade 2005 through 2017, the 12 or so years. We're particularly focused on the GFC period. And you think back to the Great Recession when a lot of companies in the US were really struggling through that period. You can see returns here do dip. They dip from around about sort of 10.7, 10.8% down to around about 10. So it's certainly not falling off a cliff. And if you think about over the broader decade and what's gone on in the US economy over that time, you'll see that returns here are incredibly stable, incredibly reliable. And this is the core of what we're trying to invest in. So that's utilities, very stable performance. Now, what I want to do now is just explain exactly how the regulation works. So I'm going to talk about this, first of all, from the regulator's perspective, and then I'm going to talk about it from company management perspective. So the regulator starts with this. They start with step one, which is that the regulated utility is allowed to earn a return, a cost of capital, on their capital employed, what they've got invested in their rate base, their property, plant and equipment. So they're essentially allowed to earn, or the regulator works out at step one what they're allowed to earn in profit, net profit after tax. So this is almost the opposite of a normal business. A normal business starts with volume, how much it's going to produce, determines a price to determine total revenue. These guys work out their profit to begin with. Step two is then, let's go back to that. Step two is then what that gets imposed upon the company. So they've got to pay tax, you add that back. You've got to pay interest expense, you add that back. You've got to depreciate the capital base, you add that back to work out revenue. So they've started with profit, they've added back all the different expenses to work out what their total revenue is. And then the regulator says, okay, well, how much volume are you going to produce? They divide that total revenue by volume to determine the price. So this is exactly opposite to the way a normal business would work. And this is the way the regulator works. So three parts to that process to determine ultimately the price that consumers are going to pay, but starting with the profit that they're going to allow the utility to earn. So that's how the regulator thinks. How does management think? Well, they start with step one. The regulator, like any business, they're trying to maximise profit. The cost of capital is essentially given to them. There's some stuff that can happen at the margin, but essentially it's fixed for them. So their job as managers is to see what they can do in terms of getting as much CapEx approved by the regulator as possible. They're trying to maximise the capital investment. Second step is actually the bottom bit. Within that context of trying to maximise profit and get as much CapEx approved as possible, they've got to think about the political issues here. And the political issue is what's happening to customer bills. And essentially what they want to do is they want to try and keep customer bill increases to inflation. So they've started with maximising CapEx, but they've got to be cognizant of that political imperative. And therefore, in the bits that happen in between, they've got to look at what they can play with, what they can manage, to get to minimise the impact on customer bills. Now, there's not too much they can do about tax. There's not too much they can do about interest rates. There's nothing really they can do about depreciation. So it comes down to operating and energy costs. So there's a cost of running the utility, and there's the pass-through cost of the energy. They're the things that ultimately will impact what managers are actually able to do here. So essentially what they've got to do, got to maximise capital investment, and they've got to absolutely minimise their OPEX and their energy costs. The energy costs will often be a pass-through, and well, it is a pass-through for these guys, so it's imposed upon them. So there's probably not too much they can do about that. So really what they do, they can hope for the best on energy costs, and they can minimise their operating costs. And that's the way that they're thinking about it. So two key things in order to achieve earnings growth. To achieve earnings growth, firstly, you've got to maximise CapEx. You've got to maximise your capital investment. And then you've got to absolutely minimise your operating costs or your energy costs to enable you to pass that through. So let's look at actually how some of these guys have performed. So firstly, American Water. So this is a water utility. Over the last sort of decade, we've gone, the American Water got spun out in the early part of the decade. So from 2010 through to 2018, they've grown EPS at roughly 8% per annum, 7.7% per annum. So dull, colourless, boring utility, but it's managed to grow its earnings at a very reliable, predictable rate, 8%, which is kind of attractive. And if we look at the next 5 years, they're forecasting similar numbers, 7 to 10% through that period. In the gas space, Atmos Energy, it's grown earnings over that same sort of period, around about 8.7%. So again, very consistent growth in earnings, kind of attractive from where we sit, and it's forecasting it's going to do it for the next 5 years, their forecasts. And then finally, in the electricity space, WC Energy done a similar sort of thing, grown earnings at 7% per annum over the last decade, looking to grow earnings at 5 to 7% over the next 5 or so years. So these are companies that are consistently delivering what we would regard as pretty attractive rates of growth over long periods of time into the future. There's that evidence of that long-term structural growth in earnings. So if we deal with the first part, why are they able to actually grow their capital investment? You've got different things happening in different sectors. Firstly, in the water space. Well, firstly, with water, if you look at the US Society of Civil Engineers, they rate water infrastructure in the US at somewhere between D and D+. Not exactly the report card you want your child to bring home for you. So it's ordinary. And then secondly, you look at what the impact of that is. Well, in the US, 20% of water gets lost, gets through leaks and the like and through their pipelines. So in an environment or in an era where water scarcity is an ever-present issue, they're losing 20% of the water that enters the system. The third piece is that roughly 3 trillion litres of untreated sewage gets released into rivers and waterways in the US. That's the untreated component. So these are all symptoms of a sector that needs significant capex to bring it up to 21st century standard. And then finally, the government owns roughly 84% of the water companies and 98% of the wastewater companies, the sewage companies. That's important because those government entities, municipal entities, are typically capital starved, and they are significant acquisition opportunities for these companies. So water utilities have got this phenomenal opportunity to invest, to actually improve the infrastructure, and there's a need for that, and they've got an opportunity to acquire some of these government-owned entities and improve their underlying operations. So that's the water space. Gas. Now, Tim's mentioned PG&E, which had some wildfire issues last year. If we go back in time, the Erin Brockovich story, they poisoned the water hole. In San Bruno, they blew up the community. So this is their gas utility. And what happened in San Bruno, they had some old pipes. Those old gas pipes ruptured. 8 people died, 35 houses were destroyed. And this is a result, ultimately, of a lack of maintenance of the underlying infrastructure. So you can imagine that when you go to a regulator now and tell them that you're interested, if you're the regulated utility, and you've got some old pipes, old gas pipes, and you want to upgrade them, they're pretty keen to improve that. So this is a structural tailwind for gas utilities. And then finally, electric utilities. What we see with electric utilities goes back a long time. If you go back to the 1880s, when light bulbs were invented, not too much happening in electric utilities, but from that point on, through to about 1960, there was significant investment in electric transmission. From 1960 through to about 1990, that capital investment really tailed off. It really softened out. And as a result, in the 1990s, 2000 period in the US, there was a significant period of brownouts, of blackouts, of really inefficient electrical systems. And as a result, what we've seen from 1990 onwards is a significant increase in the underlying capex in transmission. This is a multi-decade trend that's going to keep on going because of the requirement for grid reliability, the fact that the grid already is congested, and the fact that they need to replace a lot of this ageing infrastructure. So both water, gas, and electric utilities all face significant tailwinds, allowing for future capex. Now, I want to deal with a couple of case studies in particular, American Water. So American Water, 2010 to 2018, 7.7% EPS growth. 7 to 10 is what they've forecast for the next 5 years, with their words saying that they expect to be at the top end of that range. There's 3 parts to that. Market-based businesses, so they've got some competitive businesses that'll give them about 1 to 2%. They're going to acquire some government businesses. They expect to acquire government businesses. That'll give them another 1 to 2% in EPS. But the bulk of their growth here is about regulated capex. And what have they actually done? If we look here again, this is their slide. Over the last 5 years, they've done 7.6% growth in their underlying capital base. So there's significant amounts of capex going into their capital base. And they expect to continue to grow that over the next 5 years at something like 7 to 8%. So this long-term trend, this secular trend in underlying capex continues. So then, okay, they've maximised the amount of capital investment. What's happening to customer bills? Are they able to reduce operating costs? Well, back in 2010, their operating costs to revenues were about 46%. Today, 2018, they're at 35.5%. Well, 2019, this year, they expect to be 35.5%, with a goal of getting to 31.5%. So they're continuing cutting down on their underlying operating costs, allowing for that profit to flow through. Second example is Atmos Energy. So Atmos Energy is the largest pure-play gas utility in the US. It has around about 3 million customers in 8 states across the southwest and the west, Texas, Colorado and the like. And their operations include both gas distribution, the big gas transmission pipelines that run across state, and storage assets, so integrated gas utility. So what's happened to their EPS? Grown at 8.7% over time. As we look forward from today through to 2023, they expect to grow their capital base at roughly 14% per annum. So they're putting significant amounts of capex in. And as a result, EPS growth expected to continue to grow. their own forecasts in terms of dividends are looking at something like 7% growth in dividends over the next little while. Again, why? Well, they've got to maximise the amount of approved capital investment. I've talked about San Bruno and what that's meant. Well, for these guys, if we look on the left-hand side, you'll see the number of miles of gas pipelines that they've been replaced over the last 5 years and the next 5 years. So back in 2012, they replaced about 350 miles of gas pipeline. 2017, it was about 650 miles of gas pipeline. Over the next 5 years, on average, they're going to do about 850 miles of gas pipeline. And at the end of that, if you look on the right-hand side, the far right column, you'll see they've still got around about 25,000 miles of gas pipeline that's old and needs to be replaced still to go. So let's call that 30 years of CapEx pathway. That's what I would call structural growth. So then what have they done on the customer bill front? Well, they've been helped along by the fact that the gas price is low. So this is looking at the natural gas spot price over the last decade or so. You can see we're down at very low levels historically, and the dotted line there is looking at the futures price and what that's implying. In other words, the gas price ain't going nowhere. So low gas prices means that ultimately customer bills, they've been able to maintain at very low levels over time, and notwithstanding the fact they're going to spend a lot of money on their underlying capital base, you can see that on their forecasts, 2022, they'll be back at roughly, and on average customer bill, roughly where customers were back in 2008. So low customer bills, exactly what we're after. So that's the sort of the utility picture. What I want to talk a little bit now is transport infrastructure. So if we start with what we see with infrastructure, the first thing is that price gets regulated, not earnings, and therefore volume is a key driver of earnings and ultimately value. Earnings are not constrained by regulation. If we can identify those assets where volume is going to grow strongly over long periods of time, we should be able to identify those assets who are going to achieve attractive returns over time. So if we start with airports, this is the standard airport economic model. There's really three income streams: aeronautical, non-aeronautical, or the shopping centre, if you like, and then finally the property component, the rental of office property and warehouse property and the like. The aeronautical component, it's number of passengers times a regulated price to work out aeronautical revenue. So your price is regulated, but passengers are not. Therefore, as passengers grow, you can achieve kind of attractive returns, kind of attractive growth in revenue. On the shopping centre side, neither component is regulated, and therefore passengers can grow, your passenger spend rate can grow, and you can get an attractive return out of that. Finally, with property, you'll have, it's really a function of the amount of money you can actually get invested in productive properties. Given that you already own the land, you should be able to earn an attractive return there. And the more passengers you have coming to your airport, the more attractive location it is for a property rental. Now, so each of those things is leveraged to essentially to passenger growth. Operating costs are not. Operating costs are largely fixed, and there's some variable component, but essentially if you have 1 million passengers coming through your airport or 2 million passengers, there's not a significant difference in the underlying operating costs. So revenues should grow with passengers, operating costs should not, and therefore there's significant operating leverage available to you, provided passengers grow. So what have passengers done? This is looking at global passenger growth across the different airports. 1970 through to roughly today, and essentially passenger growth's been a ballpark around about 2 times underlying GDP across most markets. Now, every so often we have these demand shocks, the GFC, September 11, SARS and the like, where passengers will go sideways or down in a particular market for a period of time. But as the chart shows, passengers come back and they come back to the trend line. They do that because the people get wealthier over time and the cost of travel declines. And this is looking at the average return airfare over a similar sort of period. You can see airfares continually in decline, and for very good structural reasons. New aircraft are cheaper to operate. It's a very competitive industry, the airline industry, so ultimately those cheaper operating costs end up in the pocket of consumers. And secondly, the move to low-cost carriers has meant that, again, there's more competition on price, and we expect that trend to continue over time. So structurally, this trend we expect to continue. We expect GDP per capita to continue to grow, and as a result, this underlying long-term structural trend in passenger growth is alive and well for airports. Now, these are the particular airports in our portfolio. These are the 4 major positions. We have 5 or 6 different airports in our portfolio. we're focusing on here is the difference between the navy blue or the darker blue and the lighter blue. The lighter blue is the passenger growth, the darker blue is the earnings growth over time. It goes to that leverage that I was talking about, that operating leverage. So we expect growth in passengers over time. We also expect there to be faster growth in earnings over time. Now, the example on the far left-hand side, AENA, is showing spectacular operating leverage. That's because it was an IPO situation. So there was a significant cost out opportunity. So it's almost one-off. But the other three examples, I think, are symptomatic of what we might expect over the next 10 or indeed 20 years. All right, let's talk about toll roads. Toll roads benefit from four particular factors. The first is that economic growth in a catchment ultimately leads to increased demand for roads. The second is the corridor effect. If no one really likes toll roads, you build them because the government's broke and the free roads are full. And if the free roads are full and there's economic growth coming through a catchment, then ultimately that traffic growth has only got one place to go, and that's the toll road. So you benefit from the growth in the total catchment. The third thing is that toll roads are highly price inelastic services. You put up price and you'll see little or no response from demand over any reasonable time frame. And then finally, the thing that they do benefit that not many people recognise is the embedded real options. And by that I mean if any traffic growth in the network, ultimately in the broader network, it can benefit the toll road, even whether or not the toll road is the instigator of that growth. And we'll show you an example of that. So first of all, this chart looks at the relationship between GDP per capita and car ownership around the world. And you can see a fairly direct relationship. You've got the US up there at the top there at roughly 800 cars per thousand, or 800 vehicles per thousand people. Australia not too far away. And then, you know, as GDP per capita declines, so a more muted relationship. So as wealth grows, demand for cars, and therefore demand for toll roads is going to grow. So then secondly, let's talk a little bit about the corridor effect, and this looks at the M5 corridor in Sydney's southwest. So, and we're showing here in each of those columns three different colours. The two blue components are the free roads. The orange component is the toll road. So from 93 through to 2016, the catchment grew at roughly 2.8% in terms of traffic, 2.8% per annum. The free roads went backwards at 0.1% per annum. Why did they do that? They were full. They couldn't take any more traffic, basically. And as a consequence, the traffic on the toll road grew at 6.6% per annum. This is a classic example of what we're looking for. Now, if I talk about this one, this is one that really, as some of you will know, this warms the cockles of my heart. This is the Eastern Distributor, built in time for the Olympics, because that's what Olympics are for, building infrastructure, and started with a $3 toll. Last year we hit $7.53 on the tolls. And you can see, despite what you may have learned in Economics 101, that, you know, demand and price inversely related, here price goes up and volumes keep going up. And why? Well, when you put up the toll price, people will go and use the alternative road. But if there's no capacity there, then that's essentially a car park. So they will come back to you, and they'll come back after a week or so. Now, you can see the rate of growth in traffic is slowing. That's because this thing is nearing capacity. And therefore, the opportunity here is to try and improve capacity over time. And there's probably some things they can do. But this is exactly what we would expect out of toll roads. Tolls up 150%, traffic up 118% over the period. So highly price inelastic. And then finally, if we look at the M2, this looks at the real options available. So we're quoting those numbers there over the entire period. So traffic up 4% over the period, revenue up 9%, EBITDA up 10%. Over the shorter period from when the widening happened, so the M2 was widened, the widening finished in 2013. The widening had to happen in response to the growth of that area. The widening led to an improvement in EBITDA of close to 20% from there on. A strong example of that real option that's available to toll roads, that you benefit from what else goes on in the network. All right, let's talk a bit about telecommunication towers. Now, telco towers, mobile phone towers, if you like, benefit from a couple of things. Firstly, the continued explosion in wireless demand. And secondly, the need for infrastructure to keep up with that demand. So if we think about demand, in the US, Cisco have projected that in the US over the next 5 years, or from the 5 years from 2017 through to 2022, that the number of connected devices will increase by 70%. So 70% increase in the number of mobile phones and Internet of Things connected devices and the like. As a result, the amount of data is going to grow by 5 times, 36% per annum. And why? Well, it's all those things down the bottom there. It's the prevalence of Facebook, of YouTube, of Netflix and the like. It's the amount of video and data that we're consuming over time. So how do we deal with that? If you think about how a wireless signal gets used, there's a couple of key components of infrastructure. The first one is the macro towers, the big towers that sit out there, and they are core investment for telco tower companies. In addition to which there are small cells, things that are typically around about the size of a Rubik's Cube that sit on top of buildings or indeed on top of lampposts and the like. So small cells are increasingly used to infill the infrastructure in a given catchment. And then finally there's fibre, which once the towers or the small cells propagate the data goes back via fibre backhaul to be processed. So there's key components there. Crown Castle owns 40,000 towers, 65,000 small cells, and 65,000 miles of fibre. So it owns exactly this infrastructure that's going to need to be expanded over time. And as a consequence, what we've seen here is if we look at their adjusted funds from operation, they're essentially their cash flow from operations. You can see that's grown in the navy blue, very reliable, predictable manner over time. The lighter blue columns are our forecasts over the next little while. Very reliable, predictable earnings growth for structural reasons for long periods of time. So, in essence, we define this properly, and we should be very confident of delivering very reliable long-term returns. That's the first. Secondly, if we can identify those things where there's structural growth in earnings, and we think we can identify those opportunities across the infrastructure and utility spaces at the moment, then we should be very confident about delivering something that's actually attractive over time. All right, so I'm just going to talk a little bit about the fund. We have 2 objectives. Like all Magellan product, we want to achieve attractive risk-adjusted returns. In the case of infrastructure, we believe that's inflation plus 5%. And we want to protect capital in adverse markets. So how have we done? If we look at the far right-hand side, since inception numbers, you'll see we've done 8.8% per annum versus the index of around about 6. So we've certainly done inflation plus 5 and a little bit, and we've done a little bit better than the index over that time. So, you know, we think that's at least a pass mark. And then if we think about protection in downside markets, this looks over the last 5 years. It looks at those months when the MSCI has fallen. And in those down markets, when the market has fallen, on average, we've done 0. So we've had 0 downside capture. You can see our benchmark's fallen by around about half the amount of the market. Our upside capture is consistent with the benchmark. It's a little bit under, 0.6 versus 0.7. And you can see our beta is 0.3 over that period. So again, we would give ourselves a pass mark in terms of that. This is trying to deliver very predictable, reliable returns, and they should be, or should give investors some degree of protection in down markets. If I just talk very briefly about our portfolio, there's a couple of things I want to bring out here. I mentioned before that utilities are roughly 60% of our defined universe and infrastructure is 40%. We're around about 36% in utilities at the end of March, around about 56% in infrastructure, close to 8% in cash. Compared to this time last year, that's actually an increase in our utility exposure of about 6 or 7%, a decline in our infrastructure exposure. And in essence, what we've been doing through that 12 months, and in particular over the last 6 months, is buying US utilities, using a little bit of cash. We would have been around about 10% cash at that point, and selling a little bit of infrastructure. And that's really purely a valuation call. If I go back to January 17, around about January 17, US regulated utilities got to around about 24 times forward-looking earnings as a multiple. We can justify about 20 times. And as a result, at that point, US utilities were less than, or around about 10% of our portfolio, and utilities were about 30% of our portfolio. Today, we've had something like 15 to 16% US utilities, and as you can see, around about 36% in utilities as a whole. So the movement on valuation in US utilities has led to us increasing our exposure to that part of the portfolio. The flip side is that we've seen infrastructure do very well through that period. It doesn't quite offer us the opportunity cost of capital that it did a year ago. So net buyers of US utilities and net sellers really of European infrastructure, but infrastructure more generally in that time. As I mentioned, we're now at about 8% cash. We've been gradually drawing down on that. We've held high levels of cash for 5 years or so on the basis that we expected interest rates to rise. And as and when they rise, we expected US utilities in particular to come under pressure. US utilities did come under pressure. Rates didn't get to where we expected them to go to, but they did come under pressure. We're probably a little bit more sanguine about rates today, and so we've started to just redeploy that cash back into the portfolio. The final point is really around US. You can see US is 34% of our universe. It's around about 55% of our opportunity set, so we're underweight the US. We're underweight the US ultimately because we're underweight US utilities. Of the 55% that we could invest in the US, the bulk of that, probably 80% of it, something like 40%, is in US utilities. US utilities, as I said, are becoming more attractive to us, but they're not the main game for us just at the moment. And on that note, I'm going to call Tim back up for Q&A.
Okay, so we're going to run through questions for about 15 minutes or so. If there are questions you've got from the floor, please put up your hand, the microphone will come to you. We've had a number of you who have sent through questions ahead of time, which I'll take from here, so thank you for doing that. Gerald, the theme of interest rates, sort of a number of angles probably want to take on that. First of all, if we think about the outlook for interest rates and how that factors into your investment process, both from sort of valuing and assessing stocks as well as how you shape the overall portfolio, what does that look like and how are you thinking about the various scenarios?
Okay, so given a few people have asked about this one, here's some I prepared earlier. So when it comes to interest rates, we think about two things. We think firstly about the impact upon the business itself. What does a rise in interest rates mean for the businesses that we're looking at? And secondly, we think about what does it mean for valuation. If I think about the businesses, first off, when it comes to utilities, they're regulated, it's a pass-through, so a rise in interest rates, we would assume that a rise in interest rates mean that there's inflation out there. Both the increase in inflation, the increase in their operating costs, and the increase in interest rates means that a utility will go back to its regulator, sometimes with a lag, or probably with a lag, but they'll go back to the regulator and have their revenues reset so that they can achieve that cost of capital on their underlying cost base. So it's a pass-through, and they should be largely immune at a fundamental level to that. Transport infrastructure tends to be regulated at the point of price rather than earnings. Think a toll on a toll road, it's automatically escalated with inflation. And therefore, again, as inflation grows, leading to an increase in interest rates, you've already captured that in your price. And provided there's no drop-off in volume, and we certainly don't expect that on a toll road, as I've shown you, then once again, you're largely immune to an increase in interest rates or an increase in inflation, or certainly should be. So fundamentally, you're fine at the income level. So then we've got to worry about the balance sheet. And what has happened here is that these companies have taken the opportunity of the last 5 years where rates have been very low to lock in their debt at very low rates of interest well into the future. And if I look at the third and fifth point there, I'm going to focus on Vinci. Vinci last year, first half of 2018, raised €2 billion of 10-year debt at an all-in cost of 0.59% per annum. So rates have gone up since then. So this year in February, they raised $1 billion, 12-year debt, at an all-in cost of 1.375% per annum. Well, I'm certainly not getting too upset about that. So these guys have taken this opportunity, they've locked in their debt for long periods of time well into the future. If I was talking about this topic back in 2007 or 8, we would have been saying that the average debt maturity across our portfolio was something like 3 to 4 years. That is, the companies had locked in their interest costs for the next 3 to 4 years. At the moment, the average interest maturity, the average debt maturity across our portfolio is something like 10 years. So they've locked in these sorts of rates for the next decade. Now, that doesn't mean that they won't have debt that rolls. They will. And on our modelling, we would expect that if we assume that there are going to be interest rate rises. Now, that's a moot point today, but if we expect interest rate rises, on pretty much all scenarios, we would expect their average costs across their debt portfolio for them to reduce over the next little while. That is, the debt that they're replacing as it rolls off is at a higher interest cost than what they're currently having to roll their debt at. So again, both at the income level and at the balance sheet level, we think these companies are largely immune from rises in interest rates. So then we've got to worry about valuation. Now, there's 3 major interest rate rises over the last 5 or 6 years: the taper tantrum, the Trump bump, and then US tax reform, late 17, early 18. Each time the US 10-year government bond yield, the rate that we focus on, rose by around about 90 basis points. And each time, if we measure infrastructure by the Magellan Infrastructure Fund, which is the way I measure it, infrastructure took it in the neck. It fell by roughly 5%. So rates go up, and there's a widely perceived orthodoxy, frankly, that infrastructure is a bond rate proxy. And as a result, in the short term, less marginal buyers and less marginal sellers, and prices come off. And if rates go up 1% tomorrow, as night follows day, infrastructure will fall. I'm pretty confident about that. But if we look at the longer term impact, this is the Magellan Infrastructure Fund over that same period. The 3 orange circles are the 3 interest rate rises. And you can see each time, shortly after that, the Magellan Infrastructure Fund has not just come back to zero, it's come back to the trend line. And why? Okay, in the short term, there's this orthodoxy, but over the longer term, the true clientele understands what's going on here. The fact that interest rates were going to rise was not really, that wasn't news to people, that was widely expected, and it had been priced. And provided the endpoint on interest rates is consistent with what's being priced in the market, then this should not cause us concern. It will cause volatility, but it shouldn't cause fear to our underlying values. And if I look at when we value assets today, we're valuing assets closer to 4 than we are to 3% as a risk-free rate. So we're essentially using a risk-free rate as our base case. We run a range of sensitivities, but a base case of about 3.75%. That compares to the US rate today of about 2.1%. So we're expecting interest rates to rise over the next 2 to 3 years by 1.5 to 1.6%. That flows into our forecasts, into the way that we model interest costs. It flows into the way that we value these assets. And on that basis, we think our market's at worst fairly valued and arguably cheap. That's at 3.75%. So if rates don't get there, then that doesn't cause me too many sleepless nights. It means what we're doing is cheaper than what we're currently allowing for. We remain concerned about the risk. We'll always be concerned about the risk. It's a risk that we can't get away from of real interest rates. And so if real interest rates rise precipitously, that causes us problems. But at the moment, we'd be pretty sanguine about that.
Okay. Question down here.
Can you hear me? Can you hear me?
Yep.
Yes.
My question relates to 5G. Will 5G, is it worthwhile connecting to NBN since 5G is on its way here? And the other issue is how soon before 5G is practically operational in Australia? And thirdly, what are the health benefits associated with the 5G? Because it seems to be at the upper reach of the the ultraviolet spectrum, in the ionisation area. So,
I don't know about Tim, but I'm somewhat out of my depth here, but I'll tell you how we try and think about some of those issues. When it comes to the NBN, I really can't advise. We're interested in the NBN from the perspective of, is it investable and will they IPO it? On the basis of their commercial parameters, it's not investable for us at the moment from what we can see, but we'll worry about that when that becomes an issue. In terms of health benefits, all I could say is something we have monitored. We can see arguments on either side. There's no strong view that it creates health issues from what we can see. And then in terms of the deployment of 5G, well, part of it's deployed today, and it won't be black or white. It will be a process, an ongoing process over time. I know within the CBD, if I look at my phone, there are many occasions when my phone goes to 3G and even 2G, let alone 4G. So, there's still parts of the network where you're predominantly on a 3G system rather than a 4G system. So it'll take some time for 5G to be fully deployed. It certainly offers, people have certainly gotten excited about it, and in our world as well, in the world of investing in telco towers, we've seen pretty strong movements in some of the share prices for those companies. So, and there is some excitement to be had. Volumes are going to grow, as we talked about, but the specifics of the rollout, we can't be too sure about just at the moment.
Cool. Okay. Question down here.
Just with the, do you think the possibility of governments actually approaching infrastructure owners to buy these assets back? Like if you look at the example of the, say the M5 situation, where the prices for the toll's gone from, say, the $2 range to over $7, and I think that was probably over about an 18-year period.
Yep.
Public pressure would probably, probably put governments into a situation where they look at buying these assets back to combat that. Do you think that's a possibility, or have you seen any examples of that around the world where those sort of pressures have emerged?
I absolutely think it's a possibility. There are two key risks ultimately infrastructure faces: real interest rates rather than nominal. Nominal, just the inflation gets captured hopefully. So real interest rates and sovereign risk. And sovereign, the risk that we've got to be worried about is the pressure, if you like, of social licence. And does that ultimately mean that concessions that we invest in or could invest in get acquired by the government or nationalised? That can absolutely happen. What we seek to do is to invest in jurisdictions where we're confident in the rule of sovereign law. That's why we don't invest in China or Russia. So we're looking for environments where we can be confident about that. We've seen many places around the world where governments have sought to nationalise or abrogate the rights of private companies. And we see that go to a court of law, and the court of law has typically upheld the rights of the private companies. Indeed, for us, I describe that as the bell going off saying that jurisdiction is investable. We've seen that happen in Australia. If you go back to Bob Clark, when he first stood for Parliament, part of his platform, he was going to get rid of the tolls. And that part of the platform lasted about 4 weeks after election, when he again came out and sort of said, essentially, as it turns out, there's a contract and we can't do that. So what we're going to do is we're going to pay cash back. We're going to pay part of people's bills. If you're the toll road owner, I can't think of a better thing that could happen to you, that someone else pays your bills for you. So that's an example. We've seen that happen in Canada, we've seen that happen in Mexico and Brazil, in many countries, really in all countries. Now, as we speak today, in the UK, the Labor Party, the alternative party of government, has said that as part of their manifesto, that they're going to nationalise the utilities for these sorts of reasons. So that's a real live example. Our analysis of that situation is yes, they have the power to do that. Perhaps more importantly, they've said that they're going to pay net assets. They're going to pay book value, accounting book value for those assets, or a maximum of book value, in fact. Market value for regulated utilities is normally about 1.3, 1.4 times book value. So for owners, although they're facing a loss, they've traded down, but they're facing a loss from where those things were trading. We'll have to see what the political calculus holds for the UK after the events here a couple of weeks ago. I'm certainly not in the business of predicting political calculus, but that is a real risk. And so for us at the moment in our portfolio, we have zero exposure to UK water. We have around about 1% exposure to the UK. In our view, at the moment, the UK in the infrastructure world is less investable than France. And that's the first time in my career I've been able to say that. The UK causes us real problems on a sovereign risk front just at the moment. So yeah, we absolutely need to be cognizant of those issues. We look at all jurisdictions on that basis. It's a risk we can't get away from. It's always going to be there. Just as real interest rates is a risk we're always going to have to deal with. And we seek to mitigate that as best we can over time.
On the toll road front, you had the chart up there with the M2 and how that's grown over time. Obviously, we've seen the Metro open in the last couple of weeks. What does something like that, a substitute asset, mean for volumes on the road going forward? So
potentially there's some competition there. The stats are in Sydney, the last transport usage data study we saw was that roughly 80% of trips every day happen by private motor vehicle. Something like 12% to 15% happen by public transport, and the rest are people walking or using their bikes or swimming, I guess. So 80% by private motor vehicle. Now, the nature of public transport networks is historically they were built to bring people into the CBD. Metro and the like is now going to bring people into other employment networks, but the way that Sydney works is that it works in a very networked way, and that is people are crossing the city and so on. So the bulk of transport is actually related to employment, either going to or from work or between places of employment. And as a result, we don't expect the Metro to have a significant impact upon underlying traffic levels on the M2. And indeed, if we look around the world, we can find I don't think we can find any situations where the development of public transport has led to material declines in road transport over the medium term. So we just don't see that happening.
Number of questions submitted beforehand about the defensiveness or not of your portfolio. So how should people think about that? You know, if the specific question here, you know, if the S&P 500 or ASX 200 drew down 30, 40%, what should we expect from Magellan's infrastructure fund in that environment?
So the answer to that question is what's caused it to draw down. Because if it's interest rates, we can expect that over that drawdown period, infrastructure will have some downside capture. You know, it'll probably be close to 1. And the reality, if you're talking a 30% drawdown, that's the world going to panic. And when panic happens, correlations are at 1 basically. So if I assume that that's interest rates, I'm not sure that the outcome in the short term is pretty. For me as an investor, if I see that outcome, I'm filling my bootstraps because I don't think these things are particularly exposed to interest rates over the medium to long term. They will be in the short term, but over the longer term, I don't see that as an issue. So that wouldn't necessarily cause us great concern, depending upon where interest rates have gone. Perhaps a 30% decline implies a 10% real interest rate or something. Now that could be ugly, you know, without knowing the reasons, it's difficult to give a definitive answer on that.